Hello, and welcome to another episode of Get Your Fill, Financial Independence and Long Life, where we explore ways to achieve those two goals. And financial independence is something that I know we're all interested in. So today I'm excited that I've got Rich Kasparian on with us. He is the founder of Garden City Financial Group. He and his firm work passionately to help individuals, families, and businesses to plan, manage, and pursue their financial goals with confidence in a world where there's a need for sound, personalized, and objective advice because it is confusing and it is overwhelming sometimes. And there's sometimes no common sense. So, Rich, thanks so much for being with us today.
Thank you. Glad to be here.
So, Rich, have you always been interested in the world of finance?
Yeah, I believe so. Probably from a young age, I had some, really some big interest in it. And early on, I guess in my college years, I always remember taking one course, and we had a professor that worked on Wall Street, and he just went through so much beyond the textbook, and that was a sort of a springboard from that point on.
Yeah, sometimes somebody like that who has a real passion, and it could get you excited, right? If you just sit there and say, I know some kids are born like reading the Wall Street Journal, but I think it's really helpful if you have somebody to sort of spark that in you. Interesting. So I know right now, I mean, the market is just crazy, right? So people are saying, oh, it's not a good time. What should I do? What are your thoughts? I know it's the same because I'm in real estate, right? And everybody's like, oh, is it a good time to buy a house?
Right.
Like, no, why don't you wait another 20 years and for them for prices to double, and then we'll talk again, right?
Yeah, then we'll talk, right. I think I'm sort of a contrarian on the market. So I sort of I don't sugarcoat things with customers or clients.
Yeah.
So I just kind of go through the way things are and then try to navigate at that point. So I don't think there's any, set point to say, well, this is the time to jump in or the time not to be in.
Right.
And we just have to, look at some basic numbers. The Dow is down about 6% from the high of the end of last year. And then the more sort of aggressive indexes like the Russell 2000 and the NASDAQ, they're down like 23 and 29%. So the point being is, how are people positioned? How are their portfolios positioned? There's a lot of strategies that can be used to mitigate downside in these times. There are. It goes beyond just sitting down and waiting for things to go back up. So one of the things we try to do with customers is do a review of their portfolios, kind of see where they are, look for duplication, which what we find is 9 times out of 10, people think they're diversified and they're not. They own, let's say, 5 mutual funds, and they realize that all 5 funds all own the same stocks. But unless you dig down deep, you'll never know that. But there are, again, strategies where you could mitigate downside, protect some downside, or even have future income that's guaranteed. So those are sort of the things we look for. In terms of when to jump in, yet the bottom is always the best time to jump in. Unfortunately, those are the times people are in most panic. So they usually don't, and then say 2 years later that I should have jumped in back then. But no matter where you are in the market, if you're investing or you have a 401k and continue to invest, again, you want to look for ways the way you can, mitigate downside.
Yeah, it's interesting how, if you walk into a store and something's marked down, like you were just saying, the Russell's down 29%, I'd be like, hey, it's on sale, right? That's great.
Right,
It's on sale, 29%. But instead people going, oh no, I'd rather wait till it's full price or even a little higher. It's like very counterintuitive. Right. Why do you think we're like that?
I think because the market, whether it's the stock market or real estate market, is so emotional with people. And if they can't pull the emotion out of it. It's the same as the person, they bought a stock and then the stock is up 10%, it's up 20%, it's up 30%, and they don't want to sell it. Well, they don't even want to sell part of it. So that's it, and I call that sort of the Las Vegas mentality. On the flip side, they look at things differently also. and they'll say, I don't know, it's too volatile for me. And that's really, it's just the emotion. I think it's just all about emotion.
Yeah. Yeah. It's interesting. I mean, especially now. I mean, even like when COVID hit, I was like, oh my God, all this stuff's on sale. I was buying everything in sight. I was so excited,
Right.
And other people were like, oh, what are we going to do? I'm like, what are you going to do? You're going to buy something, But
Right. No,
yeah,
it's
it's
true. I mean,
very
people
nerve-wracking.
forget when COVID hit, the market dropped down to 18. I think the Dow dropped to like 18 or 19,000. And nobody would have ever believed that the market would go from 19 to 36 pretty straight up the Dow. Like
Yeah.
you couldn't even believe that that could be possible, but it actually happened.
Yeah, it was that. But now how can you, when you first meet with somebody, what kind of a process do you go through with them just to sort of make sure that you're going to be speaking their language?
Right. So the basic process is always to sort of review and see potentially what they have, number one, how they're invested, and then really from this point on, what are their goals? So those are really the main focal points. Once we sort of determine that, we'll then set up a second meeting. And then in the second meeting, we'll start looking at what changes potentially need to be made, or how we can implement a different program or utilize the program they already have. So that's sort of the thing. I basically work backwards with clients in terms of investing. So unfortunately, in this business, if a customer had $100,000 to invest, many financial advisors, unfortunately, want to invest $99,900 of it. What I'll typically say is, how much do you need to see in the bank to make yourself feel comfortable first? So I work completely backwards.
Yeah.
So if they say, well, no, I have my nest egg in the bank, I don't really touch it, and this is the amount I want to invest, and that's a different story.
Yeah.
But that's really important, because the last thing you really want to do is invest money, and then 6 months later, a year later, the client needs cash, or they need $5,000, they need 10, and before you know it, they invested in something and now they have to pull money out. So those are sort of the first important steps that I look at.
And that's so key though, because people are then hopefully people are a little less nervous as they're watching their stock fluctuate, right? Because they know they have that little bit of a cushion.
Exactly. Yeah. I mean, well, people will still panic if things are down. Now, what I will say is most of the strategy that I implement has some sort of protection or downside. So, for example, there are programs out there where you invest in and you will have guaranteed income in the future. There are many programs out there offered through some insurance companies that do that. There are other programs where you might invest in the S&P 500 or the Russell 2000 index, but if those indexes are down after a certain period of time, let's say 3 years, there's a protection, meaning if you're down, say 15% and you have 15% protection, the company, the institution has to put 15% back into your account.
Oh, wow.
There are other programs in the bond world there are notes in the bond world where also at maturity, if an index is down, there's a downside cushion. So there are these programs out there that I utilize that even when the market's down, people realize they have this cushion versus, the normal, say, mutual funds or ETFs or stocks, where if it's down, you kind of got to pray things go back up.
Is there a trade-off for that type of protection?
In the old days, there used to be a big trade-off, meaning that, well, if in order to protect this, you're going to lose this, on the upside. That's really changed. It's really diminished. I mean, in many of these programs right now, you're realizing a good chunk or almost all the upside. So it's changed a lot. When those protection type programs rolled out in the early 2000s, you were giving up a lot, not so much anymore.
That's great. Then it seems like sort of a no-brainer then to have at least some
Yeah,
type of
and
cushion.
I mean, and I always say to people, we have, you have insurance on a car, on a house, on all these things, but on investments, people just they just don't think about it. They just oh, I lost. What am I going to do? Well, it really doesn't have to be that way.
Interesting. So can you talk more about that? Because I don't think most people know that there's an option. Like if you put it in the stock market, you're just going to lose money and that's the end of it.
Right. So in the insurance world or in the annuity world, there are programs whereby there are programs that will provide you lifetime income regardless of market conditions. You still have the ability in those programs to realize market gains as they increase. But in the long run, you have a guaranteed income stream in retirement years. And sometimes those could be done for a household or even a joint household that would pay out for life.
Wow.
In other programs offered in that world, it's not guaranteed income for life, but it has that downside protection I was talking to you about, where you'll invest in, say, an index like the S&P 500 or the Russell 2000, and at a certain term, whether it's a 1-year term or 3-year or 6-year term, if that index is up, you will realize the upside of the index. But if the index is down, the house covers a portion of the downside. And you get to set those parameters of how much downside protection you want. Of course, the more protection you have, the little less upside you'll have. But either way, you'll have protection. And then there are programs in the bond world. They're called there are notes. There are notes in the bond world that are tied to indexes, which also have downside protection. And those bonds are called structured notes, are offered through major institutions: Citigroup, Morgan Stanley, JP Morgan, Goldman Sachs. The list goes on and on. So those are just sort of 3 examples of protection factors. You're not going to get it in the stock world. You're not going to get it in mutual funds. You're not going to get it in ETFs. But in these sort of other programs, you can get some of that coverage.
So how we know that Goldman Sachs is not in the habit of losing money. So how are they making sure that they don't end up on the bad end of that transaction?
What they do, what a structured note actually is, and not to get too much into the weeds, but what a structured note basically is, it's a bond that's tied to an index. Let's say the Russell 2000, the NASDAQ, the S&P, the Dow. It's tied to an index, and it offers so let's say it had a 5-year maturity. At the end of 5 years maturity, if those indexes are down, there's a downside protection built in. When these institutions like a Goldman, like a JP Morgan, like a Citi build these notes, they're built with options to protect the downside. So the house is protected, and basically the customer is protected up to that downside point. And those downsides could even be higher. Some of them are 30 or 40% downside protection over a period of 5 years, depending on the maturities are different. They could go 2 years, 3 years, 5 years, even a year and a half. But yeah, that's how, and there are new issues. They generally come out monthly. So these institutions are issuing these notes every month. But the option strategy is what protects the downside.
So is this something that you would get a monthly type of an income from, or a monthly payment dividend
You
type
can.
style
I mean,
thing?
some notes are tied into sort of long-term, let's say a 5-year gain, in terms of growth. Other notes, you can get a quarterly or monthly income. Some of them, we call them income notes, and they again have protections at maturity. But you can get income from them as well.
Okay, great. And what do you think, how big of a factor is a person's age?
Age is very important. I mean, how close are they to retirement? Are they in retirement? I think the parameters of a retirement are totally different. We all know that now. The days of, someone retiring at 55 and, going out into the sunset is totally different. People are working much later. Anyone in the professional fields are definitely working much later. But I think age is definitely an important factor. And I think people's biggest thing nowadays is, am I gonna have enough money? I live a long life. Am I gonna have enough money? That's the biggest factor right now.
Right, exactly. And how can we protect ourselves from that? I mean, obviously savings are going to be depleted no matter what, if you live long enough.
Right. It's the first thing, I always encourage, if you have a 401k, put as much in as you can. That's pre-tax. It comes out of the check. You kind of don't feel it. If you can up it a little, up it as much as you can. Of course, if there's a match, that's even better from the company you work for. Beyond, say, if a person doesn't, let's say a person owns a business, there is no, maybe in their company, they might offer 401k. If they don't, then they could look at programs called SEP IRAs. That's like a business IRA. You can look at, and the way of SEP typically works is you could put in 25% of your compensation for the year, your payroll W-2 compensation. You can look at a simple IRA, which is a small type of IRA, but it allows you to put even more money away. And you can offer this to employees, even if it's a small shop, 1, 2, 3, 5 people. So those are certainly things you could do. And then on the short spectrum, you can look for investments that go out maybe 5 years. So typically what I look at is, in a portfolio, short-term needs, your cash needs. Then we look at sort of a midterm of about 5 years. Then we look at long-term.
And how do you feel like your firm and your own way of working with people is different from sort of the traditional financial planner model?
I think that most financial planning models, or most sort of the normal way of doing things, is somewhat old. I think what a lot of advisors will do is they'll look at performance. They'll show you performance of various funds or various ETFs or stocks, and say, all right, this is the trajectory, and we'll follow it, and we'll invest this way. I think that's the norm. I think if you approach it the way we do, where we're looking at saying, look, the market, hopefully the market goes up, but if it doesn't go up, here's how you'll be protected. I think that's the total difference. That's just, we're presenting the market from a totally different angle of saying, if things go down, here's where you'll be at, versus when things go up based on history, here's where you're going to be at. Right. That's the difference.
Yeah. And I think there's probably more appetite for that now, because for a while, the stock market was just going up. And I think people who got in, 10 years ago thought it would always ever go up, just like the real estate market. Oh, it's only ever going to go up. Like, no, actually, it doesn't ever work that way.
That's right.
Those of us who are a little older know that it just doesn't always go up.
Yeah.
Yeah. Interesting. Do you feel like when you meet with younger people, do you have, how is that conversation different? Are they more challenging because they've got, Robin Hood and they know everything about everything? And I mean, I'm not trying to be mean to young people, but I'm just saying, do you find the conversation any different?
Yeah, I mean, I think the conversation is different. I mean, when we have a big referral business, and a lot of times my customers will say, hey, can you meet with my son, or my son wants to meet with you, my daughter wants to meet with you. The conversation is different because you want to encourage them at that age, 2 different things. Definitely put away for retirement. You can make things a lot easier if you do. Even if they're young, like a young couple, or they're married, or they have children, we'll talk about life insurance, which is sort of things that people don't even want to talk about. or can't fathom. But again, these are important issues. So the conversation is definitely different because in a lot of cases, they can't project out that far. It just seems like it's so far away. So you just got to kind of reel that in. And then you want to look at the immediate. Do you own a house? No, I don't. Okay, so are you saving for a house? So then we have to, look at all those factors, because if we meet with a young person, they don't own a home, but they have a lot in savings, and that savings is for a house, then they shouldn't invest it. Right. So those are sort of the conversations we have.
Yeah, I know a lot of the young people who I meet with for real estate transactions, they have a kind of an idea of, they don't have that long-term vision. So they're thinking, I'm going to put it in here. Like one friend is like, oh, this bank account is paying $500 if I open an account. So I'm going to open an account over here, and then I'm going to take that money, and then I'll open this over here, and then I'm going to do this. And I'm just like, my head is spinning, right? There's no idea. There's no thought process of like, you put it here and you just leave it there for 50 years, right? That's just not even
right.
So I would think that'd be a little bit of a challenge to instill.
No, it is
mindset.
Definitely a challenge. It's definitely a challenge.
So, Rich, who are your sort of favorite kind of people to work with who when they come to you and they start talking to you, you think, oh, this is going to be fun. I'm really going to enjoy helping this person to understand my world.
I can't say there's a specific type of customer. The one thing you learn in business, and just to give you a little background, worked on Wall Street for many years. Then I was with Citi Smith Barney for years when things were collapsing in 2009. I ventured off to and opened my own practice now, coming up on 13 years. And I think what you see is the challenge, sort of a challenge. So the challenge customer would be, they have these different statements and things just don't make sense and they need to be deciphered. And that's sort of where I get a charge from, because I know that once I kind of do all this research and we figure it all out, then we could sort of simplify things. I had a customer, funny quick story, years ago, where she did like a small investment, and then I started to say, well, what else is going on, or what, and then little by every day she would bring in like a new stock certificate that she found in a drawer. And this literally went on for almost, like, I'm going to say, a year and a half. Between stock certificates and statements, weekly she would come in with these things. And it went from being a very tiny account, to a 7-figure account. And I always remembered her saying, you made my life so much easier, because she says, I knew I had all this money out there, but I just couldn't track any of it. So, back in the old days, people held stock certificates. And now actually, if you do, that's kind of the worst thing to do, because one, they could get lost. Two, if you want to sell, it's very difficult. So when you get that old stock certificate, you want to put them in a brokerage account. So now you see the shares, and if you want to buy, sell, you can do whatever you want. So.
Yeah. Oh my gosh, that's funny.
Yeah.
Found another $10,000.
Yeah. That literally was how it was going, between her and her husband. So.
That's fun. So do you have any like books or podcasts or advice or something for somebody who's just sort of starting out and thinking about, well, maybe I should invest in this. People actually say this to me, even at my age, right? I'm in my 50s, almost 60. And people my age say to me, yeah, I don't really know anything about the stock market. I probably should take some of my money out of savings. And I just go, oh no. But how can they start to educate themselves?
There are a lot of good people out there that you could, look up and follow. I would say, our website is www.gardencityfinancialgroup.com. You can read some of my blogs. There's videos. Also, we have a YouTube channel, Garden City Financial Group. Great. There's a lot of, helpful videos on rollovers and investing and market climate. So that's a kind of a good start. People can also contact us, through those, through the website. But I think that's a kind of a good starting point. So even if people aren't invested, they can at least get some good tips, if they go there.
Yeah, excellent. Yeah, it's a super resource. Great. So what other sorts of things do you think that you love every potential client to know already before they come and talk to you?
I think a couple of things. One, that protection of investments is important. If you're completely emotional about the whole market, and if you're either afraid to look at a statement online or in the mail, or panic when you do it, then you really should think maybe I shouldn't be investing in the market. Things like long-term care and life insurance are very important things. They should be reviewed and looked at. I think those would be the basics.
Yeah. And you talked about life insurance, and I think that is something, especially that young people are not interested in getting, right? It feels to them like, oh, what do I need that for, right? How can you help
Right.
educate us real quickly about what the different uses for life insurance besides just your death? Does that make sense?
Sure. You'll hear a lot. You'll hear about life insurance, term insurance, and universal insurance, and whole life insurance. There's all life insurance is really broken up into two main categories: term and permanent. Term insurance runs for, let's say, 10 years, 20 years, 30 years. And permanent insurance, as long as you make your premiums, will continue generally for life, depending on how it's set up. Normally, when we sit down with somebody and look at a program, depending on how much insurance they need, will determine which way we would, look or go. It's not unusual for, say, a family of 4 or 5 to need $1 million in insurance. In these times, that's not like out of the realm. When you think you're in real estate, what houses cost, and then so the main things when you're buying insurance you're looking for is debts and income replacement. Those are the two main things. So if a person passed, income replacement and debts. Now that does not mean that if a person passed, every debt has to get squashed. There's always that thing you hear, oh, I bought this was a mortgage insurance, mortgage life insurance. Well, there's really nothing really called mortgage life insurance. It's been presented that way. What it is that, well, if the house, someone passes, the house will be paid in full, but it doesn't mean that's always going to happen that way. Yeah. The third thing we generally look for life insurance for is college savings or college planning, just in case, one person passed. But college savings has gone so crazy that it's really become sort of the third piece that's people aren't that focused on. Yeah. Term insurance is generally cheaper, less expensive, and will run for a number of years. Obviously, the younger you are, the better. So if the person is 30 years old, it would be great to do, any kind of life insurance. Permanent insurance will be more expensive, but it will generally last for life. So that's generally how it works. We don't just deal with like one insurance company. Our system lets us look at various insurance companies, come up with various rates or the best rates. And insurance, remember, is predicated on, do you smoke? You don't smoke? Are there any health conditions? So all those will come into play in the process. The process can take anywhere from a few weeks to 3 months, depending on the age of the person and their health. But we sort of walk the customer through. I mean, basically all the customer generally has to do is answer the questions for the application, and there will be blood work required.
Yeah.
Generally speaking, if they're around 30-ish, there's usually no blood work. But if they're beyond that, then there's generally blood work. And that's pretty much how it works.
Okay, great.
It
So-
is also, it's tax-free. It's also tax-free to the beneficiary life insurance.
Oh, right. Yeah, that's a great
Right.
point.
Yeah.
And something that I don't know if people realize is, people think, oh, so-and-so left me the house. But if you don't have a way to pay off that house, then you may not be able to get it. They think, we'll just sell the house to
Right.
pay, to pay off the debt. But you can't sell the house because you don't, it's in probate, you don't own it, and you can't use the proceeds of something you don't own yet. So it can be very complicated. And I don't know if people realize that, where life insurance will just pay it and you can pay off the mortgage if you don't have that mortgage insurance.
That's absolutely true. And it's a good point you bring up. The other thing we try to get clients involved with, and we'll, if they need an attorney, we can give them a few referrals, or if they have their own, we recommend it as 3 things that every customer should have. I mean, everyone really should have is a will, a healthcare proxy, and a power of attorney.
Yeah.
So those are 3 things that any attorney can, generally speaking, do. If it's a larger business client, then there's more things that need to be done in terms of trusts and whatnot. But just for the basics, those 3 things, will, healthcare proxy, and power of attorney, are really important things.
Yeah, definitely. So Rich, I love talking with you. I feel like our time is like flown by, but what do you wish that I would have asked you that I just didn't think to ask? What is there, a burning thing that you're like dying to tell everyone?
No, you're not putting me in that position. You asked me, actually, no, you asked me everything that I would have covered
Okay.
pretty much.
Wow, great. I think that's a first.
Yeah.
So how can people, you gave your website earlier, but why don't you just quickly tell us how people can get in touch with you if they want to take advantage and talk about some of the cool programs?
Sure. So they can go to gardencity.financialgroup.com. There's a contact us page there. You could send questions, or just say, hey, I'd like to be contacted. YouTube channel, Garden City Financial Group. You can go there as well. I'm also Rich Kasparian. I'm on LinkedIn. So those are just 3 different vehicles where you can find out more information or contact us. We're in Garden City, New York, which is in Long Island, but we service customers throughout the whole country.
Excellent. Excellent. And all those links will be on the show notes page, so you don't have to worry about writing them down or remembering them, because we will have them there for you. Rich, thanks so much for sharing your wisdom with us.
Thank you. It was great to be on the show.
Yeah, it's great to, for people to think about this idea that you don't have to lose money every time the stock market goes down.
That's right.
And thank you, listener, for being here with us. I know you have a choice of podcasts, like maybe, I think there are over 2 million podcasts to choose from now. So we're really excited that you're here and you got to learn from Rich. And you probably know somebody who might want to retire someday. So why don't you forward this episode to them and allow them to also take advantage of all the wisdom that Rich has shared, and have a fantastic week.